From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for June 10th, 2022. The Brewers are back on the road again. This weekend they start a 9-game road trip in Washington. And just a heads up, tomorrow is National Donald Duck Day. And just like Donald, you can celebrate without wearing pants. A mom hoping for Mom of the Year honors bought tickets for her kids to see the punk band the Red Hot Chili Peppers. And this is where those good intentions went south. It wasn't the Chili Peppers she bought tickets to, but a tribute band. A tribute band that plays Red Hot Chili Pepper music on bagpipes. Oh, kill me now. From California, in order to get federal protection for bumblebees as a threatened species, a 3-judge appellate court ruled that bumblebees are fish. That's just going to make for some pretty weird fish fries. In Toronto, a guy broke into an office building, ate a couple of sandwiches out of the employee's fridge, then photocopied his face using the office copier. I feel you're way ahead of me here, and you'd be right. He left his face in the coffee tray and was quickly arrested. And that might be the greatest mugshot in the history of mugshots. This next story is kind of weird. More than 800 New Yorkers aged 75 and older are going to get a new friend. The state is distributing robot companions. They're programmed, for example, to help with socializing, engaging in small talk, sharing memories, contracting loved ones, and even cracking jokes. Yet more technology for Grandma and Grandpa. What could possibly go wrong? And finally, this is a story about the laziest drug dealer ever. A man in Detroit sold marijuana from his vending machine that was attached to his house. He stocked that machine with product for 4 years and cleared $2,000 a day and never got busted by the cops or even the neighborhood watch. Well, our lazy dealer finally did get arrested. And he explained the vending machine allowed him to watch the Johnny Depp trial without those pesky customer interruptions. On the podcast today, we have Brian Kilb, Chris Everts, Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thank you, Max. A rough week overall for the markets. Highlighted, I think, by a pretty rough day today. The NASDAQ down 5.6% this week, closing at the bell at 11,340. The S&P down 5.1% this week, closing at 3901. The Dow Jones Industrial Average, after shedding 880 points today, finished the week down 4.6%, closing at the bell at 31,392. For the year, the return on the NASDAQ down 27.3%, the S&P down 17.6%, and the return on the Dow Jones Industrial Average down 12.8% when you factor in dividends. So, Joel, I think some pretty obvious places to start this week. We're looking at a Fed meeting next week in which it now seems, or has for a while, seemed likely that a 50 basis point move would happen in the overnight rate. I think clearly with the consumer price index number that came out today, it's clear that they've got some work to do on the inflation front.
Yeah, Kyle, so it was 8.6% consumer price index increase from a year ago, May, so that 1 year increase is the most since December of 1981. It's considerable and it's psychological. I mean, it affects a lot of the headlines that are in the paper and the shouts on the newscasts, and so people are, if they're not watching the prices on the gas pump or the price of eggs are up 32% from a year ago. They're certainly noticing it by the news that they're consuming, and that can have an effect on spending.
And Brian, obviously, the market's reacting, I think, in part to what the expectation is for the Fed, right? That if inflation is as sticky as it's now proving to be, if the Fed has been, I think, considerably behind as we look at this print, considerably behind kind of navigating the inflation issue. I think the investors are rightfully concerned perhaps about what the Fed will need to do to really get it under control. And so And I think, again, it speaks to the sell-off this week. It speaks to the declines we've seen so far this year. But as you look at the markets, not just this week, but kind of the expectations, what are you seeing?
Well, I think the first thing is, who expected this to be resolved overnight? We talked about, kind of fighting our way down to 3,800 or so on the S&P a couple of weeks back. And people were like, oh, did we hit a bottom or did, V-shaped recovery? You're like, wait, whoa, this is going to take a while. I think we aren't going to really have a good grasp on inflation for a few more months yet. I don't think we're going to have a real good grasp on the supply chain problems for a few months, and I think we're going to have to work our way through this thing. And I think in the process of that, we're going to have days where it feels better and days where it feels worse. I mean, and you just look, I think, at where we were earlier in the week, I kind of felt much better about things. And within a span of 24 hours here, the S&P's down, 200, 250 points, and we're kind of back to that neighborhood where it gets a little scary again. So I wouldn't be too concerned about the ups and downs in the next few weeks. I'd keep my eye on where we're going over the next few months and see if inflation's going to end up not at 6 or not at 2, but, is it going to be 3 or 4, and how fast are we going to get there, and what are the implications? And I think in the meanwhile, the Fed's going to keep doing what it's going to do, and we'll just need to keep our eyes on the long run.
And Brian, even within that, the report from the Labor Department on Consumer Price Index, there's nuanced stuff in there that suggests that maybe it's not as bad, maybe it's getting better. If you take out food and energy costs, the Consumer Price Index went up 6% year to year, which is still pretty high. But it's better than it was in April, which was 6.2%, and it's better than it was in March when it was 6.5%. So, it depends upon what you look at, but it's still high inflation.
Well, I think that's part of my point too, though, is you're going to get a couple good ones and then a bad one, and a couple bad ones and a good one, and you're going to feel better one day and you're going to feel worse the next, because this isn't like straight up or straight down stuff, right? And I think we were just talking about the difference between the core number and in the aggregate number, and even those things tell you different signals from time to time, and I just think what matters is what this thing's trending over the long run, and so you got to back up and take a week like this, or even the last couple of days, with a grain of salt and say, well, where are we really going? And if the core's gone down 3 times in a row, maybe that's a trend, but I think certainly on a day-to-day, week-to-week basis, we're going to have volatility for a while,
Chris, maybe touch on valuations here just a bit. The forward PE multiple for the S&P 500 now, right around the really long-term average for the S&P. We're at 16.6 right now, with expectations for about $235 in earnings per share on the S&P. And so, I think we're in the midst clearly of a correction. We've flirted already with the bear market for the S&P, that technical 20% drop, flirting potentially again based on kind of the pain we felt this week with the bear market. And I think, just an important reminder for investors that in these kinds of environments, market declines don't stop just because you reach fair value. They stop because there's some kind of sentiment that, okay, all the selling that was going to happen has now happened, and what's left is, okay, let's digest the rest of this uncertainty. So as you look at valuations, clearly some opportunity out there, but also some reasons maybe to be a bit more cautious.
Yeah, so valuations, let's take a look at where valuations have come from. We started where valuations were maybe 10, 15% overvalued prior to this correction, right? And now we've seen valuations come back to what I would call fair value. It seems like a good place to buy in terms of where earnings are at. But to your point, regarding valuations and what that means for the market in the short term, valuations are not a great predictor for short-term performance for the market. If you're buying based on valuations, you're buying for the next 5 to 10 years, right? You're not buying based on what you think is going to happen in the next 6 months. What drives the market in the short term, more often than not, is momentum, right? What direction is the market currently heading at? And, people trade based on the way that they feel in the short term. And eventually momentum switches. And if you're the long-term investor, you kind of ignore the current momentum and wait to find, good buys at good valuations. So the longer-term investors, which I'd say most of us are sitting around this table, we'd sit and say, I'm waiting for valuations to get attractive, and I'd look to buy. And even if momentum's against me, that's fine. I'm looking for the next 5 to 10 years.
I tell you, the thing I'd say about valuation is most people have no idea what something's worth when it comes to stocks. I don't mean that to discredit people in general, but they don't have the financial skills to make a determination of what an individual company is worth, or collectively what many companies in an index or a market are worth. And I think, how do you understand what to buy if you don't understand what something is worth? So people are buying stories, they're buying momentum, they're buying potential opportunity, but they don't know what to pay for because they don't know in today's, they don't have some sense of underlying value or whatever. And I think that's really dangerous, and always a really good reason why the market does go too far to the extremes, way overvalued, way undervalued. And, I always kind of thought you could cover a lot of mistakes by buying cheap, and you're always going to get chances to buy cheap. And I don't know how cheap today is, there may be cheaper tomorrow, but I like to be patient and wait till you really get some value for something before you spend your money.
Yeah, I think we often, in these kinds of environments, talk about picking up nickels in front of steamrollers, right? And this idea that, if you see a nickel on the ground, go ahead and pick it up. But if you're going to do it to put yourself in peril, maybe not the right choice. And I think that's kind of the feeling that so many people have right now is, okay, maybe stocks are cheap. Maybe they can get a lot cheaper. To me, that says stay the course for a little while. You've got stocks already. You don't need to be rushing into whatever the next deal is. If you're looking to put cash to work, great. Long term, you're going to look pretty smart buying at these prices. But if you're thinking, well, now's the time to change what I'm doing, I think that's a different conversation. And, I think you rightfully point out a lot of this is about what things should be worth. It's the same conversation, I think, on the economy side, right? So often we don't really have an understanding of what's really going on, and so we rely on feeling. And Joel, we got consumer sentiment report this week that I think talks quite a bit about feeling and how people really feel about what's going on right now.
Right, yeah, and one reason that economists watch consumer sentiment is because we know that consumer spending runs 70% of our gross domestic product. Well, so the numbers out today, and they're preliminary numbers from the University of Michigan, says that consumer sentiment's at an all-time low. They said it's comparable. How people are feeling right now is comparable to how they felt in the low days of the 1980 recession. So that's pretty bleak, and no surprise, most people are blaming that on inflation. They're seeing prices go up, and they're thinking that the outlook isn't very good. Brian, I know that you wrote something earlier this week to some of your clients that you don't put a lot of stock in the consumer sentiment numbers.
Well, I mean, I think this is twice in the same podcast. I'm going to talk about most people not knowing what they're doing. but I think if you look at consumer sentiment and you're like, well, why are most people bad at this? Okay, one, because they don't understand the concept of valuation. The other is because they're ruled by their emotions, right? Fear and greed. And, how many times have you heard us say, it's the only market where prices go up, right? People buy more and prices go down and they sell, And so if part of our metric was, by and large, more people than not are bad at this, why are we listening to them? Seriously, what do I really care how they feel? Now, I think the argument, Joel, I'll make both sides of the argument, would be, well, if people feel bad, they're going to spend less money. But I don't believe that's true.
Well, and actually we had numbers this week from the Federal Reserve on consumer credit, on credit card debt.
Exactly where I'm
and
going.
That's back to where it was at the beginning of the pandemic. At the beginning of the pandemic, it took 26 months to recover the low that it went to, which, so it's covering $133 billion from January of 2021. And in the Great Recession, it took 10 years to recover that. So I think we're in a time, and there was talk this week about stagflation, of high inflation, which we have, and recession or a contracting economy, and which we don't have yet. Well, that not officially anyway, but the difference is that the economy overall is still pretty strong. There are still a lot of indicators that show that the economy is strong, and that's one of the reasons that the Fed has to do something, is to slow that down.
I'm sorry, Kyle, go.
No, I was just saying, we got a report from the World Bank that suggests that I think globally the risk of stagflation is significantly elevated. And I think when you look at the strength of U.S. consumers, the strength of the U.S. economy, yeah, there is certainly some slowing that's taking place. But at the same time, we're coming at this from a very different position than where we've come at this ahead of prior recessions. So if recession is really where we're headed, well, okay, the consumer's far stronger. If recession is really where we're headed, okay, well, the economy isn't quite pointing to that yet, even if the stock market is. And so I think, it's different in a lot of ways. And I think that the danger is saying this time's going to be different, right? But you also have to understand the nuance. And there's a lot more nuance out there than, what I think a lot of people are willing to visit right now.
Well, and I think the nuance or the difference this time around is people have jobs. And there's a dearth of labor. There's, you could have some slack in the market, some slack in demand. You could have a recession, if you want to call it that, and you're still going to need people, And if you go back to a lot of the times in history where this cycle felt the same, you had labor problems on the other end. Now, that's what a recession is, when a lot of people don't have jobs and they don't have money to spend. It's probably not going to happen this time, I thought it was fascinating that Janet Yellen kind of threw herself under the bus and said, I was way wrong about, inflation and some other things lasting longer. Then she also said she didn't think there'd be a recession. Like, that's a pretty interesting combination of two sentences right there, and I think there's some truth to that, that some things are going to get dicey along the way, but it would be hard for me to see it get really ugly as long as people are working and contributing to that 70% of the economy, Joel.
I think we have to be clear about our expectations for the Fed as well. We don't expect that they're going to predict the future. We don't expect that they're always going to know what things look like. We expect that they're going to respond to the data as it comes, and I think the Fed has been clear that that's their intention. They've been clear that, while maybe 6 months ago a couple of quarter-point rate hikes might have been enough, we're in an environment in which they have to do more, and they will do more. And so, the conversation now is, well, do we do a little more in the summer, or do we just let this run a little longer into the fall? Maybe the right answer is somewhere in between. It isn't so much going to be about what's the exact perfect answer to solve this tomorrow. It's, does the Fed continue to take the right actions to get it under control? And then what do they do once we're there, or what do they do once the data starts to change and recession becomes the risk, or something else becomes the risk, whether it's employment or whether it's that inflation just is a little stickier than what we had hoped. And so, I think that's the critical piece to remember is this isn't about how well you forecast the future. It's about how well you respond to things as they happen.
How much do you think they pay attention to how people react to what they're doing? If they don't, hike the interest rates as much as expected, people will be disappointed. So maybe they're locked in at those higher rates.
Yeah, I think that's fair. I think, important to remember that by mandate, that's not something they really are tasked with looking at, but it doesn't mean that that's not what they're looking at. I mean, price stability, full employment, really the dual mandate of the Federal Reserve. And as you look at that, you go, okay, but all of these things are part of a feedback loop. And so you do kind of have to anticipate, I think, if you're a part of that voting membership of the Federal Reserve, you do have to anticipate how is this going to be received.
I think the other thing, too, is you can't say to me that, we threw a bunch of money in the post-financial crisis world to keep things from getting uglier. We threw a bunch of money at the economy the last few years to keep COVID from getting worse. And then in between did all kinds of other stuff. That to get back to normal, to undo some of that, it wasn't going to be some pain and suffering. The pain and suffering we're getting right now is inflation. And if it's bad for a while, we're not going to care 10 years from now. What you're worried about is it getting really bad and then becoming something that is hard to get rid of, like the stagflation era was. But we're a long way from that happening, and the Fed's telling you they're going to be aggressive, and that's what you want to hear right now. So, like I said, it's going to have to play out over months and years, and we'll be watching.
Yeah, and it's not just about looking forward; it's about looking back as well, and how strong returns still look for portfolios on a 3-year, 5-year, 10-year basis. Right? That if you look post-financial crisis at just how far we've really come as an economy, as a labor force, as an investment, vehicle, whether it's stocks or bonds or whatever. Meaningfully positive numbers across the board over those time periods. And I think we miss sometimes that occasionally we get a little bit too far ahead of ourselves, and the pendulum swings back the other direction. Maybe some of what we're dealing with right now is just that we got a little more than we should have too soon. And so, I think always cautious about how we view the current sell-off, cautious about how we view some of what's going on. But at the same time, you do have to put it in perspective sometimes.
Well, and you go full circle to this, and you kind of go back to the consumer sentiment thing. Well, consumer sentiment was twice what it is now 3 years ago. So we were super excited right before all this, and now we're, we've had some pain and suffering, and now we feel terrible. I mean, we're right, perhaps wrong on both sides of the equation, which is kind of what we're saying, right? We're always looking back to what happened, not to look forward to.
To answer your question before, who expected this to be taken care of overnight? The consumer's answering those surveys, right? I mean,
Well, don't make me say they're wrong 3 times in the podcast, right? So.
Well, maybe a couple of things worth pointing out, with some of this inflationary pressure that's out there. We got an estimate for cost of living adjustments for Social Security for next year. Looking at potentially 8.6%.
So that's based on consumer product. What am I saying here? The CPI numbers for July, August, and September. So in October, we'll know that. This year it was 5.9%. That was the highest it was since 1981. And, so if you're getting Social Security, I mean, maybe you don't want the CPI to go down that much the next 3 months, because that'll help your benefits next year.
One thing I'll just point out with that, I think there's a planning discussion regarding, these increases to Social Security and what that should mean for some individuals. I think this should let people remind themselves that this is an argument for why it makes sense to often delay Social Security so that you get a larger benefit, because then a higher percent of your income that you're getting in retirement is going to be driven from Social Security, which will have that inflation adjustment for you. So if you take Social Security, right on the dot at 62, and you take, let's call it 20 or 75 cents on the dollar, which you would be able to receive later if you waited a few years. Well, now you're getting less income that has that inflation protection on it. So by delaying Social Security and maybe leaning on your portfolio or whatever it might be for a little bit, you can protect yourself more from inflation down the road. And maybe this is one of those examples of you talk about how you protect yourself from something that you're currently facing, and it might not be what you deal with 10 years down the road, but it's a good reminder for why that's a tool in your tool bag.
Yeah, great opportunity as always for the planning piece of the conversation, and I think it's so critical in what we do. It's one thing to understand here's what's going on in the markets, here's what's going on with the economy. It's another to understand how it fits in with each individual investor's needs. And so, appreciate, obviously, your insights there, Chris. Well, we always enjoy doing the program for you.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.